Recall that Korea is still an emerging market country, and the biggest part of Korea discount comes from North Korea. And we are doing scenario-based approach whereby we use the probability of normal state and that of disaster state. Okay, if you hate scenario-based approach, you could alternatively use the default spread of Korea as a country risk premium. Okay, country risk premium, and add back into CAPM equation. In that case, the default spread would be canceling each other out because cost of equity, when you're calculating it, Korea's treasury rate minus Korea's default spread was there. Now, as country risk premium, you are adding it back so that cancels each other out. So that's going to be your new capital, cost of capital, equity, right? Cost of equity. Use it for your normal business situation, and then that's gonna be it. No need to worry about downside scenario because those downside is already incorporated in this country equity premium. Okay, so that's it. All right. Kim Jong-un 쏴라 있네. Yeah, the guy is not only alive but he's cutting something. Okay, over there. Dividends and cash flows to equity, right? In the strictest sense, the only cash flow that an investor will receive from an equity investment in a publicly traded company is the dividend that will be paid on the stock. Actual dividends, however, are set by the managers of the firm and may be much lower than the potential dividends that could have been paid out. Okay. The cash flow available to equity holders, right? Dividend is deeply underestimating it because, you don't want to party all the way down, right? You want some precautionary savings and then you want to reinvest for growth in the future, okay? Managers are conservative and try to smooth out dividends, right? We're going to talk a lot about the dividend policy from now on. And then managers like to hold on to cash to meet unforeseen future contingencies like what we are going through, coronavirus 19, right? If you have rich cash in your balance sheet, okay, then you can afford to sustain your life, okay, compared to the companies that does not have any cash, okay. So precautionary saving is important, and when actual dividends are less than potential dividends, using a model that focuses only on dividends will understate the true value of the equity of the company. Now, from now on, I'm going to show you a series of, the time series of dividends compared to net income, okay? Either in the name of EPS, right? Earnings per share, which is net income per share, or net income itself, okay? And dividend per share or dividend aggregate amount, right? It does not matter. They mean the same thing, okay? So let's see. KTNG dividends versus EPS, which is smoother, is a question. Okay, is a question. Green line, that's EPS, and red line, that's dividends. And then KTNG went public in 1995. So ever since until 2016, I show you this time series plot, right? So which one is smoother? Obviously, dividend is smoother. Net income may fluctuate and come and go. It may come and go, but dividend stays very stable, smooth. Why is that the case? Because there is a dividend clientele theory about it. Okay, firm in certain industries or have investor base that looks for high dividend payout, like grandpas and grandmas, right? And then they hold on to this kind of stocks, right? Disproportionately more, right? Your grandpas and grandmas. Some of them may have given you some the pocket money, okay? They usually have their investment in KTNG and say what? I regularly get dividend payment out of it, And with this, I'm going to buy some delicious cookie for my grandchildren, you guys over there. And that's how you got your cookies, right? For this kind of grandpas and grandmas, if KT&G cut their dividend abruptly simply because the earnings is dipping, the grandpas and grandmas will be very much frightened and disappointed so much. You don't want that happen, right? So they don't, okay? The company try not to touch on this dividend too much. Keep it smooth, okay? To satisfy their dividend clientele, right? Some companies, on the other hand, they don't pay dividend at all, right? Young companies, tech startup companies, their clientele or their shareholder base is different from the shareholder base of KT&G. Grandpas and grandmas, they don't know Amazon.com, but you know it, right? Or some kind of new tech companies like Naver, right? Those companies, they don't pay dividend. And young shareholders like you guys, you don't need dividend because you are fast enough to trade, buy and sell to make capital gains and make money out of it instead of waiting for the dividend to come out, right? So that's the difference. eMart, right? Net income versus dividend time series plot is shown over here, okay? Which is smoother? Of course, dividend is smoother. Number two, is dividend big compared to net income? Okay, their payout ratio, is it big? And the answer is not really, okay, compared to KT&G, right? And then dividend versus net income of 신세계, right? eMart and 신세계, they belong to the same family, right? Almost no dividend, okay? Very interesting pattern is happening over here. Whereas their net income goes here and there, right? Anyway, ExxonMobil, their dividend versus EPS, which is smoother. You can see that dividend is a lot smoother. Net income fluctuates with the oil price. By the way, 신세계, right? Back to this. Is it reasonable to use dividend discount model for 신세계 in valuing 신세계? The answer is no, okay? Dividend deeply underestimates their cash flow. Deeply underestimates cash available to equity holders, okay? Samsung Electronics, how about them, right? Dividends and EPS are shown over here. EPS is much more volatile. Dividend, they almost never paid dividend until 2001 or something, right? But they started to pay some dividend, okay? POSCO, firms, over here you see EPS fluctuating, and then later, recently, right, 2014, 15 something, there was some bad steel market, so much so that their profit was very terrible. EPS was going down, even lower than the dividend per share, okay? So the company must have had some decisions, right? If you are standing at this point, okay, as a CEO, you must have thought about it. Should we keep on paying the similar amount of dividend as before? Or should we stop or reduce our dividends smaller than EPS, right? Net income. Should we reduce it, stop it, or keep on paying the same amount? The management has to decide on it. But remember, dividend clientele story, right? You don't want to disappoint your grandpas and grandma shareholders, right? This is a stable company that has been paying rich dividend before, right? So you don't want to disappoint it. So as long as, okay, then comes the next question. Is the downturn in net income temporary, or is it going to be permanent? Okay, if it is going to be temporary V-shaped recovery, then I'm going to just keep on paying dividend. If not, if it's going to be terrible forever, I'm gonna stop paying dividend, even though it's gonna disappoint my shareholders. It's the reality. I have to let them bite the bullet. Okay, bite the bullet. 현실을 받아들이게 만드는. It's like a bite the bullet, right? Together with me. So the management had to make this kind of decision. Should we cut the dividend or keep on paying the dividend or reduce the dividend, right? They kept on paying the same amount of dividend per share later, and that worked as a signal actually. The signal, as it turns out later on, their earnings per share bounced back. Okay, bounced back. Now, this is a nice case about the signaling hypothesis, signaling theory of dividend payout policy. Okay, outside investors don't know much about the insider information. What the heck is going on with the industry? They don't know. But CEO is the one that has the best information. And their action about dividend payout or dividend cut, this kind of things work as a signal to outside investors, right? Outside investors. POSCO was one case over there. KEPCO, okay? KEPCO is another case of signaling story about this. You see this net income fluctuating up and down. By the way, POSCO, why were they having some trouble time in the commodities market? They were swamped by other producers in India, I guess. But that was temporarily gone. In KEPCO's case, they had some trouble, okay, in 2008 and ever since, right? And then they were suffering from net loss over this time, at this time. Okay, again, take your stand. Assume that you don't, the future is not unfolded yet. Okay, if you are standing on this time at this time point as a CEO, what would you do? Well, would you cut the dividend or would you keep on paying the same amount of dividend? Well, that depends on your information and prospect about the industry and your company. If your company's future looks bright, then what? Well, you keep on paying the dividend. If you anticipate a V-shaped bouncing back, but if you believe the company will suffer from losses in the long run, right? Then perhaps cutting dividend will be good enough, right? So they cut the dividend, okay, without saying much about their prospect, I guess, right? But it worked as a signal. Oh, the KEPCO is in bad shape. So lo and behold, afterwards, their EPS was not bouncing back to positive side, okay, over a couple of years, like handful of years. They were in the negative range. And then eventually they bounced back. It took a long time, U-shaped bounce back, right? So dividend signaling story works over here as well. And then Google, yeah, they don't pay dividend because they need a lot of reinvestment to their storage spaces, you know, those servers. Amazon.com, of course, they don't pay dividends. They have to reinvest for their facilities and then big data management, all these kind of things. Tesla, how? No dividend. Come on, what do you expect, man? So that's one thing to notice, right? And then Micron Technologies. What is this? Well, this is Samsung's biggest competitor in the United States. Memory chip producer, very cyclical industry, okay? Memory chip, where does it go? DRAM kind of things, dynamic random access memory. If you look at your computer, there is a CPU, that's Intel or AMD, but there's a RAM, okay? 32 gigabytes or 8 gigabytes or 64 gigabytes of RAM. Well, that really adds to the computer's capacity, okay? That really affects your game playing in your Overwatch game or the StarCraft or whatever. Somebody moves very fast, high RAM. Somebody moves like very slowly. That's slow RAM, 8 gigabyte or 4 gigabyte. Is that even a memory? Come on. So that DRAM industry, okay, commodity. This is a commodity in computer. So Samsung is the biggest player, and then Hynix is number 2. Together they take up like a 75% market share, and then Micron Technology goes next, right? And then Taiwanese one, and goes like that, right? Very cyclical industry, because this is commodity, like no differentiation is possible, okay? Product differentiation almost impossible. All those computers, just the manufacturers, they just buy and sell the same product either from Samsung or Micron or Hynix or whatever, okay? Just like rice and wheat, all these kind of things. So the characteristic of this industry is very volatile. Why do I tell you in detail about this? Because Samsung Electronics is the biggest company in South Korea, taking up 30% plus in market cap of the whole market, right? Essentially, this is the Republic of Samsung. And then for that purpose, you need to understand the key business of Samsung in the first place. And then key business of Samsung is not Galaxy yet, but memory chip, DRAM, has been there ever since like 1980s or something. They advertise differently, so much so that, oh, Galaxy is competing with iPhone and sexy product going on there. But that's minor business. Their major, absolute major, okay, is DRAM. That means DRAM business is volatile, and then which means the Samsung's earnings will be volatile, and then Korea's earnings and stock market will be exposed to this volatility coming from DRAM market disproportionately more. Okay, that's something you have to understand first of all, as you are studying Korea finance anyway. Now, for that part, to show that DRAM industry is cyclicality nature, Micron Technology works nicely because this is 100% dedicated into memory chip business. Unlike Samsung is a little bit, a lot invested in Galaxy or other IT investment over there too. Okay, IT equipment or telecommunications business, and consumer electronics as well. But Micron has only one division, which is semiconductor. And let's look at their EPS. This is going between positive and negative in a couple of years cycle. Okay, you see drastic cycle going on over there. And then, were they paying any dividends? Barely any dividend. No, almost no. Okay, over the last 15 years, they were not paying dividend at all. Come on, why? Because you never know, okay? And this is such a volatile industry, you cannot afford to pay dividend in the first place, okay? So that's that. How about SK Hynix? This is also memory chip producer, okay? Cyclical industry, just like Micron. Would they pay dividend? Mostly not, okay? Mostly not. They have to get ready for down cycle, okay? No room for this kind of luxury of paying dividend, okay? That's why. All right, so that's that.